Hello friends, this is Hatim Rampurawala, and in this video we will revise chapter 11 of CA Final SFM, that is interest rate risk management. In this we'll be going to solve basically the illustration, and there are only two test your knowledge in this entire chapter, though there are many concepts and you would have also done many other sums as well in your classes, but since we are revising the ICI module, there are only two questions covered, so we'll quickly revise, or say quickly go through the sums. They are much simple, both of the sums are simple. Okay, so let's see. First test in knowledge. Derivative bank entered into a plain vanilla swap through on OIS, that is overnight index swap, on a principal of 10 crore rupees and agreed to receive MIBOR. So it is receiving interest on this 10 crore, receive MIBOR overnight floating rate for a fixed payment on principal, and making a fixed payment on principal. So he is incurring fixed cost and receiving MIBOR. The swap was entered on Monday 2nd August 2010 and was to commence on 3rd August and run for a period of 7 days. Okay, so from 2nd August the interest will start per day. Respective MIBOR rates for Tuesday to Monday 1 week period basically were 7.5, 8.15, 12, 8.12, 7.95 and so on, 8.15. if the derivative bank received this much net on settlement, so if the derivative bank is receiving, that is earning this much on settlement, okay, so this is basically the net profit. This can be used in calculating the fixed cost, because we would be having the revenue, this is the profit, so we'll get the fixed cost. Okay, calculate the fixed rate and interest under both the legs. Note, Sunday is holiday, so what we'll do on Saturday, we'll calculate 2 days interest on Saturday itself, because Sunday is holiday, because interest will accrue for 2 days. Then second note, work in rounded rupees and avoid decimal. Okay, so they have said work in rounded rupees, and this is the second question, but we'll discuss that later on. First we'll see the first question. See, what we have done is day principal amount MIBOR interest from Tuesday till Monday, a 7 days period, and in that we had merged Saturday and Sunday. 2 days interest will merge in that. 2 days interest will accrue. Now what we have to do is, first on Tuesday, the derivative bank has invested what we can say 10 crore rupees. Principal is 10 crore rupees, MIBOR rate is 7.75, and per day interest will amount to 21,233. How to calculate is 10 crore into 7.75 into 1 divided by 365. 1 days for 1 day, and the total days is 365, so into 1 divided by 365 you will get 21,233. Add that figure into that 10 crore and write that into the principal column on day Wednesday, on Wednesday row. Okay, and likewise keep on adding interest, like of Wednesday, that is 10 crore 21,233 into 8.15 into 1 by 365, so we'll get 22,334. Likewise the total interest income will be 1,53,740, and we would be earning 317 on the entire this transaction. So the fixed cost interest to us will be 153,423, and what they have asked in question is to calculate the fixed rate interest. So how to calculate the interest? See, this is the cost 1,53,000. this is the cost in amount term. We want to calculate the percentage basically. So what we will do is 1,53,423 divided by 10 crore into 365 days, because annual interest rate we need to calculate, 365 divided by 7, so we'll get 7.99 something, so it will it amounts to 8, approx 8. So we are done with this question. It was much simple. They had given us 7 days interest, and in this Saturday Sunday we had calculated for 2 days, that's why it is 43,764. Simply we have to prepare a 4 column table. First column day, second principal, third MIBOR, and the total amount. We'll get first the total interest income 1,53,740, deduct 317 from that. We'll get the fixed cost of 1,53,423, and then calculate the percentage, that is 1,53,423 divided by 1 crore into 365 divided by 7, so you will get 8%. So we are done with this first question, and the second question also we'll quickly go through. Mrs. Parker and company is contemplating to borrow an amount of 60 crore rupees for a period of 3 months in the coming 6 month time from now. So this Parker and company is, what we can say, is contemplating to borrow an amount of 60 crore rupees for a period of 3 months in coming 6 months. So in coming 6 months they are intending to borrow for 3 months. The current rate of interest is 9%, but it may go up in 6 months. So currently it is 9%, but it may go up in 6 months. The company wants to hedge itself against the likely increase in the interest rate. So they want to hedge themselves against this interest risk, that whether if it increases, so it will cost to the company. So they want to hedge against that interest rate risk. The company's banker quoted a FRA, that is forward rate arrangement, at 9.3% per annum. Okay, so FRA is 9.3. What will be the final settlement amount if the actual rate of interest after 6 months happens to be 9.6, or either second option is 8.8? So they are given FRA is 9.3, and what will be the actual settlement amount if at the end of 6 months the interest rate happens to be 9.6 or 8.8? So in this case we have to use one formula for calculating the settlement amount, that is N into RR, that is reference rate. In this reference rate will be the rate, see this the one actual rate after 6 months, that is 9.6 or 8, reference rate minus forward rate, that is FRA figure, basically FRA percentage, so 9.3 in this case. So what we'll do is principal amount multiply by reference rate minus forward rate, multiply by the time factor, that is time period, that is we want the loan for 3 months period, so 3 by 12, divided by 1 plus a reference rate into time period. So 1 plus reference rate is 9.6 in this case. If we see the first case, 9.6 reference rate into the time period, 3 by 12. So we'll get the settlement amount. If the amount is positive, the calculation after calculating this figure, if we get the positive figure, then the bank will have to pay the settlement figure to Mr. Parker and company, means basically to the client, if some another client is there in the question. In this question it is Mr. Parker and company. So if the amount comes to positive by calculating with this formula, what it indicates is the bank has to pay to Mr. Parker and company, and if the amount comes to negative, means in first case if the amount comes positive, then bank has to pay to Parker, payable to Parker, and if the amount is negative, then Parker will pay. There is a liability on Parker and company to pay to the bank. That's what the answer is. Okay, so we'll quickly go through. See, the final settlement amount shall be computed by using the formula N into RR minus FR into the time period, 1 plus RR into the time period. Okay, so over here N is the notional principal amount of an agreement, RR is the reference rate for the maturity specified by the contract prevailing on the contract settlement date. That is what I said, that after 6 months what is the actual rate, that is RR. Then FR is the forward rate, basically FRA. TM is the maturity of the forward rate, that is 3 month period, 6 month period, 5 days period, 10 days period, any period specific. And DY is basically for 12 months, or if we say, if we take the base as, if it is in days, then if we take the base as 360 or 365 days, basically it is a time period calculation accordingly. If so in first case, if the actual amount actual interest rate turns out to be 9.6, then what will be the settlement amount? If the actual interest rate after 6 months happens to be 9.6, apply the formula, we get the figure as 4,39,453. See, this amount is positive, hence the bank will pay Mr. Parker and company. And in second case, if it happens to 8.8, the interest happens to 8.8, and in that case interest, the settlement amount is coming to negative, that is negative 7,33,855. so in this case Parker and company will pay to the bank. Note is not that important. Okay, so we are done with this chapter as well. Only 2 questions and much basic questions. Thank you for watching the video.